In my opinion, and maybe I'm in a minority on this, but I've been very vocal on it. The LBMA and the COMEX were exchanges that were designed to offset risk. They've turned into much more than that. On the LBMA right now, you have between 4 and 6 billion ounces short in silver, where these banks, these commercial banks, which I believe are facing an existential threat, are trading up to 2.9 billion with a B ounces of silver per day. That's 3.5 times annual global mine supply. Now the numbers say 290 million per day, but they say those numbers are up to 10 times understated due to they only post the final settlement numbers, not all of the ins and outs and ups and downs that the trades that they take to get to those final settlement numbers. They have 800 million ounces of silver on the LBMA, approximately, of which 500 million belongs to the ETFs. They have a float of 300 million ounces, and they're trading that entire float every single day. And if you look at the actual trades, it's 10 times that amount every day, double the annual global mine supply in gold. But most of these trades, 90+% of them, are naked short on paper. On COMEX, you have 8 banks, 8, that maintain the largest concentrated short position in any commodity ever traded, ever, on COMEX in silver. About 700 to 800 million ounces short, as dumb as a mud wall, when the rest of the world is accumulating commodities because of the things I just mentioned: the lack of trust, the inflation, the realization that we can't normalize our balance sheet, that by pivoting proves that when they are 60% away from their target of 2%. That's not signaling victory over inflation, it's waving the white flag. And I think you can see that by the back end of the market throwing up and selling off, and the interest rates going up by 60 basis points 2 weeks after they lowered the front end down by 50. That's the back end's way of saying, no, you're trapped and that's not going to happen. So what I guess I'm simply saying is that I don't think we're in the first inning of the gold bull market, but all things considered, the environment today points to gold having a good deal of room to run before we hit the later stages of this cycle, because all of this movement has been void of American participation. As my good friend Rick Rule often says, you take Joe and Jane six-pack all the way up to the Harvard Endowment Fund, and what you see is a 1/2% allocation to precious metals. A 5% allocation is a tenfold increase. And I think you see bank failures like we saw in Lindsay, Oklahoma. Most people don't even know what a bank bail-in is. And we just saw the first one and not a word about it. You know, we bailed out Silicon and Signature with hundreds of millions in uninsured deposits. But the 7 million in uninsured deposits in Lindsay, Oklahoma, 3.5 million say bye-bye to. It ain't coming back. And that's a trial balloon. Wait until there is something, whether it be the commercial real estate eroding to such a point that we start to see real bank failures with real uninsured deposits bailed in as part of the Dodd-Frank Act legislation. And there's an awakening when people say, my God, why have I not listened to Alistair McLeod all of these years? Why have I not put some money into precious metals? And when that happens, bang, like that, you ignite the realization that there is no bull market like a metals bull market. And in that environment, the people who have made big profits in dollars, they're not going back into dollars. Are you kidding me? I don't care what kind of profit it is. So the secondary market's gone. And the fragility of this market in an asset that is, becoming harder and harder and harder to get, I think becomes stark.
Schectman's first point addresses the structure of major exchanges like the LBMA, London Bullion Market Association, and COMEX, where much of the world's silver and gold trading occurs. He argues that these exchanges have strayed from their original purpose as risk-offsetting mechanisms. Originally designed to help manage price risks for producers and industrial users, these exchanges have evolved into highly leveraged markets where massive volumes of metal are traded on paper with minimal physical backing. On the London Bullion Market Association alone, banks currently hold between 4 and 6 billion ounces in short positions on silver. These institutions trade up to 2.9 billion ounces of silver per day, which is more than 3 times the total annual global mine supply. These astonishing numbers reveal a market that's highly leveraged and deeply reliant on paper contracts rather than physical metal. The daily trading volume reported by the LBMA is around 290 million ounces, but Schectman notes that this figure may be understated by a factor of up to 10 due to the complex web of trades that ultimately lead to the final settlement numbers. If accurate, this level of trading represents nearly double the annual global mine supply of silver traded daily. When 90% or more of these trades are naked, meaning they are not backed by physical metal, the potential for a squeeze becomes a real concern. COMEX, the other major silver exchange, is similarly positioned. Only 8 banks hold the majority of the concentrated short positions in silver, estimated to be around 700 to 800 million ounces. This level of concentrated shorting is unprecedented, making silver the most heavily shorted commodity in the history of COMEX. As Schectman describes, this situation is like mud stuck on the wall, irrational and out of sync with the behavior of global markets, where governments and central banks are steadily accumulating commodities to hedge against inflation and economic uncertainty. The heavy reliance on leveraged paper trading is a vulnerability that's exacerbated by rising interest rates and inflation. When central banks like the Federal Reserve began raising interest rates, it initially seemed like a positive step toward normalizing economic conditions. However, Schectman argues that this normalization attempt is more like waving a white flag, admitting that inflation cannot be controlled without risking economic collapse. The market's reaction to rising interest rates has been mixed. While front-end rates, short-term rates, have increased, long-term rates have surged even more, reflecting deep-seated concerns about the sustainability of current fiscal and monetary policies. In this environment, Schectman believes we're not yet in the late stages of the bull market for gold and silver. He cites his colleague Rick Rule's observation that most American investors, from everyday savers to major institutional funds, currently have less than 0.5% allocated to precious metals. If a mere 5% of the financial market shifted to metals, demand would skyrocket, likely triggering a severe supply crunch. This limited participation in the metals market underscores just how early we might be in this cycle. Recent events like the bank bail-in in Lindsay, Oklahoma, where uninsured depositors lost millions without government intervention, serve as cautionary tales for the broader financial system. Unlike the well-publicized bailouts of Silicon Valley Bank and Signature Bank, where large sums of uninsured deposits were protected, the failure in Lindsay highlights the fragility of smaller banks and the risks posed to depositors. Schectman suggests that as more banks face financial strain, particularly those exposed to failing commercial real estate markets, we could see more bail-ins, where depositors' funds are used to recapitalize banks under the Dodd-Frank Act. When people start realizing that their bank deposits may not be as secure as they thought, the rush to tangible assets like gold and silver could be swift and substantial. Schectman emphasizes that a true bull market for metals is unique. Once investors see substantial returns in metals, they're unlikely to convert back to fiat currencies. This is different from traditional asset classes, where profits are often reinvested or converted back into cash. Gold and silver investors, especially those who understand the long-term erosion of purchasing power in fiat currencies, are likely to hold their gains in metals, further reducing the available supply for new investors.
As far as what Alistair said, he's right. It's not that gold goes up, it's that the currency that we measure gold in, the fluctuations of those currencies in particular. In the dollar, I did an interview the other day with a gentleman who said to me, Andy, money creation, which is really the definition of inflation from a classical sense. It's always a monetary event. It's an increase in inflation of the money supply is inflation. Price inflation is a different thing. But when we talk about money creation averaging 7%, I would argue that's a little light, but let's just play that out. He said, for the last decade, it's at 7%. Well, ironically, when we apply the law of 70 seconds to that, which says you take your interest rate and you divide it into 72, and it tells you how long before your principal doubles. So 10 years ago, the dollar was worth twice what it is today by that standard, by money creation alone, by inflation, or pretty darn close to it. And gold was $1,200 an ounce then. So did gold nearly double, or actually just over double, rather, or did the dollar lose half of its value? I think that's the important thing here, is that gold is the barometer by which we measure the health of the system. And I think the dollar has a long way to go in terms of where it ultimately ends up. It should be much less than it is. The justification for a dollar as strong as it is right now is ludicrous. I mean, we're we're right at that 120-ish% debt to GDP level, where back when I started in this industry, anything over 100% was a banana republic. And, then you throw into it all the things that I talked about in the previous question, centering around, election integrity and judicial system and all of these things. And you wonder, isn't that what people used to say was a banana republic? Election interference and debt well over 100% debt to GDP. But we'll sidestep all of that for a moment. But this is one of the reasons why I think you're seeing such a strong drive to gold. Forget about the fact that going back for 25 years, gold has doubled the performance of the 10-year treasury and has beat the performance of the S&P 500 with dividends reinvested, which has averaged about 9.6%, with gold right around 9.9% for 25 years on average. So its performance is better, but these are assets that have plenty of counterparty risk, as we see, where gold has none. To Steve's point, I know, Steve, I look like I have such a baby face, but I've actually been doing this for 35 years. And I read that book by Roy Jastrom, The Golden Sexton, and I remember a long time ago something sticking with me in that book. And that was, if I remember correctly, the overwhelming theme that yes, gold does very well in inflation, but actually does better in a deflationary environment, as it is an asset that has no counterparty liability. And so kind of Richard Russell's old saying, he or she who loses least wins. And having an asset like that maintains no counterparty liability, doesn't have the systemic risk built into it, to me, makes it even more valuable than it is in dollar terms. And this is one of the reasons you're seeing the BRICS and all of these countries in the global south accumulate gold, because of the counterparty risk of holding treasuries and because of the irresponsibility in our fiscal policy, which, is very easy to see. And you can understand why these countries are doing what they can to protect themselves. Also, to Steve's point, talking about the strength of gold, even in the face of positive real yield, a strong dollar, and ETF outflows over the last 2 years that have fallen at a 45-degree angle. Now, albeit they are starting to turn up a little bit right now, the large move that we've seen in gold, it was void of American participation. And if you would ask someone who is mainstream oriented and say, what would gold do in an environment of a strong dollar, positive real yield, and massive outflows out of the ETFs, virtually, signaling no participation by the American public, one would think that the price would collapse.
As we continue with Andy Schectman's analysis, it becomes clear that his perspective on precious metals as a hedge against systemic risk speaks to a larger narrative about the stability of fiat currency and the vulnerabilities of a heavily leveraged financial system. Schectman sees gold not just as a commodity, but as an essential barometer of economic health, revealing deeper truths about the state of the US dollar and the broader financial system. Schectman's view hinges on the idea that fiat currency, especially the US dollar, is gradually losing purchasing power. Over the past decade, the money supply has expanded dramatically, with average annual increases close to 7%, leading to significant inflation. Using the rule of 72, which estimates the doubling time of an investment, or in this case, inflation, by dividing 72 by the rate of growth, we see that at 7% inflation, the dollar's purchasing power effectively halves every decade. This phenomenon is mirrored in the rise of gold prices, which have more than doubled over the past 10 years, not because gold itself has become more valuable, but because the dollar has lost value. Schectman points out that while the US dollar remains the dominant global reserve currency, its current valuation may be misleading. Historically, countries with a debt-to-GDP ratio above 100% were considered high-risk or banana republics, as debt levels that exceed a country's economic output can lead to a crisis of confidence. The US now has a debt-to-GDP ratio of around 120%, a level that would typically signal vulnerability. Yet many Americans are still largely unaware of this risk, assuming the dollar's status as a global currency insulates it from devaluation. This resilience, Schectman argues, is due in part to high global demand for US treasuries. But this demand is showing signs of weakening as countries like China and Russia seek alternatives. BRICS nations in particular have begun to reduce their reliance on dollar-based assets, favoring gold as a more stable reserve. By steadily increasing their gold holdings, these countries are not only diversifying, but also preparing for a potential future where the dollar plays a diminished role in global trade. For these nations, gold offers a safe, stable asset that isn't subject to the inflationary policies of any one country. Another critical insight from Schectman is the counterparty risk associated with fiat currency and other paper-based assets. Unlike fiat currencies, gold and silver are tangible assets that do not rely on the creditworthiness of a government or institution. Gold's intrinsic value has historically provided a safe haven during times of economic turmoil, serving as a form of insurance against the failures of the fiat system. As central banks continue expanding their balance sheets and increasing the money supply, the risk associated with paper currencies grows, making tangible assets like gold and silver all the more attractive. Schectman also discusses the lack of U.S. investor participation in precious metals, highlighting a unique opportunity. Despite rising prices, American investors remain largely underinvested in gold and silver, with average allocations below 1%. If mainstream investors and institutions were to increase their allocations even to 5%, the demand would surge, causing a rapid escalation in prices. This demand from U.S. investors could intensify the existing pressure from global buyers and central banks, leading to a potential supply squeeze in the precious metals market. In the context of these structural risks, bank failures provide another layer of concern. Recent cases like the bank bail-in in Lindsay, Oklahoma, show how fragile the banking system can be, especially for small institutions. Under the Dodd-Frank Act, bail-ins allow banks to recapitalize using depositors' funds in the event of a crisis, rather than relying solely on government bailouts. The potential for bail-ins raises serious questions about the security of traditional banking. For individuals, holding wealth in physical assets like gold and silver outside of the banking system offers a safeguard against the potential loss of funds in a bail-in scenario. The lack of confidence in fiat currency and the rise in bank-related risks create a perfect storm for precious metals. Historically, precious metals have provided a hedge during both inflationary and deflationary periods, making them uniquely valuable in volatile economic environments. Gold's performance as an asset without counterparty liability makes it particularly appealing in a financial landscape where trust in central banks and government policy is wavering. When global central banks and institutions are doubling down on their gold reserves, it signals that they, too, are hedging against future uncertainties. One of the most intriguing aspects of Schectman's argument is the performance of gold even in the face of factors that would typically drive prices down, such as positive real yields, a strong dollar, and ETF outflows. Despite these headwinds, gold prices have continued to rise, driven largely by foreign demand and central bank purchases. This divergence underscores the growing appeal of gold outside the U.S., where investors recognize its intrinsic value as a hedge against currency risk and inflation. Schectman further explains that this rising demand is being met with limited supply, which will likely worsen as demand for physical metals grows. Many central banks, particularly those in the BRICS countries, are opting for physical gold rather than dollar-denominated assets like U.S. treasuries. These nations are aware of the potential risks associated with holding large reserves of foreign currency and are taking steps to protect their economies from currency fluctuations. As these countries increase their gold reserves, they reduce the amount of metal available to other buyers, creating a supply constraint that could drive prices even higher. For individual investors, this context highlights the importance of diversifying beyond fiat currency and paper assets. Gold and silver are not only historically resilient stores of value, but are also impervious to the inflationary policies that erode fiat currencies. In an environment where systemic risks are rising, physical assets offer a level of security that few other investments can match. For those concerned about future economic instability, holding a portion of wealth in tangible assets can provide peace of mind. In conclusion, Andy Schectman's analysis presents a compelling case for the value of precious metals in today's complex financial landscape. The rising risks associated with fiat currency, the potential for bank bail-ins, and the diminishing confidence in the dollar all point to a growing need for financial protection. Precious metals offer this protection, not only as stores of value, but also as safe havens from systemic risk. As global demand for gold and silver grows, and central banks continue to diversify away from dollar-based assets, those who prepare now by securing physical metals may be best positioned for the future. Whether you're a seasoned investor or someone new to the idea of precious metals, Schectman's insights remind us that in a world of paper promises, tangible assets like gold and silver offer unmatched stability and security. Thank you for joining us for this expanded analysis. As always, stay informed, stay prepared, and consider how precious metals might fit into your financial strategy. Those who recognize the value of real assets and take steps to protect their wealth today will likely be the ones best positioned to weather whatever challenges the future may hold.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.